America fall.
Bharti Airtel, JSW Steel, Interglobe Aviation, just some of the big earnings that are still awaited.
An interesting conversation lined up on the show today. Our Thyagarajan of Shriram Group will talk to us and tell us why the merger with IDFC was called off. We're going to be talking with markets and fund flows with IPEC. Oscar Descaya of London Capital Group, she joins us from Shanghai. The risks to the housing finance sector with Karthik Srinivasan of ICRA. All that coming up in a moment from now.
All right, but as always, let's kick it off with a check on the markets. Neeraj is with us. Neeraj, how are we closing off the month, not the quarter?
Not too cheerful, I might add. And again, PSU banks haven't quite lived up to the billing, I might add. So a bit of a fall today, PSU banks faltering again. So it's a flat day of trade. The Nifty Bank is holding up largely due to, I would presume, one, what Axis Bank has done, and two, maybe select banks are doing. But PSU banks are certainly faltering in trade today. The other interesting bit, remember we were talking about how ITs looked fairly skittish. And while HCL Tech was down in the dumps yesterday, Infosys is a bit under a spot of bother today. I think if you look at the math of the date, had you bought in yesterday, or yesterday was the last day where you needed to buy Infosys T+2 settlement, so it reflects in your account on the 1st of November, which is the record date for that buyback. So I think that having played out, Infosys is under a bit of pressure today, a couple of percentage points off. But guys, the broader end of the spectrum just continues to have amazing moves on the upside. Sure enough, there are losers like Adani Transmission, but just look at this. Balaji Amines, reported numbers good. The management actually told us that it's very, very difficult for them to predict whether this momentum will continue, and China remains a big threat now, more so than ever. The stock is still up double digits, a strong 17% move. Bharat Electronics, good reported numbers, off the day's highs, but still about 5%, and this is no small mark. BEL is a fairly decently large company. Life highs for corporates like Delta Corp, Vakrangi, and these are stocks that have had really good momentum over the last 1 month, 3 months, 6 months, 12 months, you name it, and the momentum just continues there. And you don't have to look any further than the guy which manages the Mumbai airport. Diwali was 12 rupees, is now 18 and a half. Frankly, aside of bagging the Navi Mumbai airport, I don't know what's changed. But GVK Par, 50% rise in the last, 12 or 15 odd sessions. So the momentum is strong at the broader end of the spectrum for sure.
All right, Neeraj, thanks so much for giving us a flavor of the markets and stocks that are moving. From the markets to the macros, the government's decision to recapitalize Indian public sector banks has led to an active debate on what this means for the economy and the direction of interest rates. In a note on Wednesday, Goldman Sachs said that every incremental 10,000 crore rupees of bank capital infusion can lead to an increase in credit growth by 1 percentage point and an increase in GDP growth by 0.5 percentage point. Goldman goes on to add in that report that as growth picks up, this will be bullish for equities, it will be bullish for the Indian rupee, but it will be bearish for rates as the RBI may hike rates faster than anticipated. In that report, they say that they expect the RBI to hike rates by 3 times, not by 3 times, hike rates 3 times by the end of 2018.
That's a view from Goldman, but here's a counter view. Bank recap plan may actually fizzle out if this is not accompanied by cutting interest rates, says Abhishek Gupta from Bloomberg Intelligence. He's here with us to defend this position. You're taking on Goldman right now. Tell us why you think the bank recap plan may fizzle out if this is not a dovetail with cutting interest rates.
So essentially what I do is I look at 2 interesting questions in this report. Number one is the question about are the banks currently the low credit growth in the economy? Is that because the banks are capital constrained, or is there a weak demand situation in the economy? The analysis suggests that overall the entire banking system has enough capital currently to grow at about 10%. Credit growth is currently at 7.5%. So essentially it boils down to the issue that demand is really weak right now. Real interest rates are too high in the economy. But at the same time, individual public sector banks are capital constrained. If we look at the 20 public sector banks, I think around 10 of them are capital constrained, which need to sort of shrink by 10% their book. The capital adequate banks can actually grow up to like 20%. So essentially it's an interplay of both supply and demand issues, but at present it's more of a demand issue.
Just hold the thought, Abhishek. Let's just bring that chart on the screen once again, talking about how credit growth has played out over the last several years. And if you just see the right-hand side corner of the screen, a marginal uptick, Ida, a marginal uptick in credit offtake. And many people would argue, Abhishek, that this has been because, and this is just a counter view, that this has been because of unwillingness of bankers to lend as compared to deficiency in demand.
Yeah, so elaborating on the earlier point, the second question is the government's decision to recapitalize banks by up to 2.1 trillion rupees. Will that be sufficient to provide the regulatory capital requirements of the banks, and in addition to that, leave also sufficient growth capital with the banks? So over here, the analysis suggests that RBI rate cuts will help not only on the supply side, also on the demand side. So demand side is well known. I mean, rate cuts help in propelling growth and creating demand for the economy. On the supply side, rate cuts can help in sort of the kickstarting in growth. That can help in reducing the loan loss provisions, and that can essentially leave the banks with higher capital to fund new loan growth.
Sorry, Abhishek, I have two problems with what you're saying. One, on the second point in your report, you talk about the fact that lower interest rates will allow this bad loan problem to get resolved a little bit faster because interest rates for corporates will come down, etc. But that's exactly what you don't want to do. And the RBI Deputy Governor Viral Acharya has said in the minutes that you cannot have rates which are so low that the hurdle rate for evergreening is low for these companies. You cannot allow that. And on the second side, I mean, this is now a flexible inflation targeting central bank. How can they say that, we want to revive animal spirits? They have to look at inflation pure and simple. And if the output gap is negative and widening on the negative side, sure, there is an argument to be made for cutting interest rates. But these arguments seem a little bit outside the realm of central banking.
So let me just first sort of address each of these issues one by one. Number one, Viral Acharya's whole analysis is that bank recapitalization, or interest rate cuts need to be preceded by bank recapitalization so that there is no evergreening. So if you cut interest rates, what happens is public sector banks sitting on excess SLR are going to get windfall gains on their sort of asset book. And the RBI does not want those gains to go into the existing bad loans. That is why they are proposing banks.
I don't think that's their problem. I think their problem is that you lower interest rates too much. You allow these guys to refinance a little bit too easily.
Essentially.
And risk pricing is not appropriate. If the market is flooded with liquidity, you misprice risk. I think that is the problem.
No, I think essentially in that case, there is there isn't any demand. I mean, as we can see in the chart earlier, the credit growth is too low. So coming back to the earlier point, the issue over here is if banks are well recapitalized, then they will not be scared of giving out loans to fresh demand in the market. The other 2 points which you mentioned, Ira, on inflation and output gap, over here my view is slightly different. Like my inflation projections show that inflation is nowhere close to coming up to 4% mark.
Sure.
In fact, inflation should head at around 3% by end of March 2018.
No, and if you're right on that, then sure, the RBI should.
So inflation is already undershooting. Like the last inflation print was 3.2%, whereas market was expecting to be 3.6%. October again looks like around 3.3 or so, which is an undershooting of 90 basis points given RBI's own projection of 4.2% in October. So that's a big undershoot. Given these things and the fact that you want this recapitalization program to be a success, interest rates can only help and support this recapitalization program by ensuring there is sufficient capital for banks to not only meet the regulatory requirements, but also they have enough growth capital.
Abhishek, thanks so much for that view. Like we said, a healthy debate going on which way this is going to play out for the broader economy and for interest rates. Moving on to corporate news, the proposed merger between the IDFC Group and the Shriram Group has been called off. Nearly 4 months after the discussions, we heard from IDFC Limited yesterday saying that they thought that the swap ratios could not be agreed upon and hence the exclusivity period of talks has been closed. We are now joined by Mr. Thyagarajan, founder of the Shriram Group, to help us understand his side of the story. Mr. Thyagarajan, thank you so much for taking the time to speak to us. I guess the first question simply is, why did the deal fall through?
Normally, deals take their own time to go through. What we have said is this will not go through within the time frame that we thought, no, we didn't think. Okay, initially some exclusivity period was agreed upon. And exclusivity period means during that period we don't talk to anybody else, that's all. Now that the exclusivity, within the exclusivity period, if a deal has to be struck, that would have been a very unusual and a very improbable event. No deal of this kind of an wide-ranging complexity can be completed in 2 to 3 months' time. But somehow an impression was created that everybody is attempting to complete a deal within 2 months or 3 months. It wouldn't have happened. So there is nothing surprising to me, at least to me it is not surprising that we did not complete a deal within those 2-3 months' time. So it doesn't mean that a deal will not take place at some point of time in future. It can take place.
So you're suggesting, Mr. Thyagarajan, that the deal is not entirely off the table?
The point is, even the next 8 days or 10 days, we do not see the possibility of reaching agreement on a wide range of issues, not only the valuation. See, any deal, any working together between two entities, one of which has a 50,000 employee strength, there are so many details which have to be agreed upon. One is the valuation. The second is the objective that we have. We have to have agreement on the objective which we hope to achieve by working together. Then the quantification of that objective. What will be the value creation? On that there has to be an agreement. Thereafter, the teams, the management teams which will have to implement that merger, the integration problems, those have to be addressed. Only when we reach agreement on all of them, people are expected to go forward. So it was not, at least I did not expect, at least some of us within the Shriram group also did not expect that a deal will be struck within that time frame. What was agreed upon was exclusivity, that we will not talk to anybody else in the meantime. That's all.
Sorry, Mr. Thyagarajan, I'm going to repeat the question because it's not entirely clear to me what you're saying. Where do things stand? Are you saying that you're willing to consider a counter offer from IDFC? Are you talking to others now that the exclusivity has ended?
Everybody is focusing only on the valuation. As I said, that is one of the important issues. There are 3 or 4 other important issues. On each one of them, there has to be agreement between the parties. If it is not there, supposing we had agreed on valuation, which I think is a very minor issue we could have, but there are other issues on which we could have had differences, then also the deal would not have taken place. To say that because of the valuation expectations not being met on either side, the deal is not going through is an oversimplification. It is not the case. Even if we had agreed, it doesn't mean that the deal would have gone through. There are other issues on which we would have started talking.
So among the other issues, what was the biggest stumbling block, sir?
Most important thing is how much of value would be created for the shareholders if a merger of this kind takes place. On that, there has to be agreement. Our estimate of the benefits of the combined shareholders of both the enterprises, our estimation of the benefit would have been a value creation of at least 10,000 crores to 15,000 crores. Now, IDFC's shareholders and IDFC's team management will have to see the logic behind our expectation and feel satisfied, yes, this is workable. So there is a need for agreeing, because only in the context of that, you would be looking at today's valuation. Supposing you find that the valuation is not attractive to IDFC, they should look at what is it that they are going to get at the end of 2 years, the shareholders will get. If that is substantially attractive, then you wouldn't mind giving up something here. So there has to be an agreement on what would be the value creation that will take place because of the merger. Then who is going to implement that? We have executives, we have employees on our side. IDFC has got executives, they have got strengths, many strengths in many areas. Our people have strengths. We have to see how these strengths could be merged in such a manner that the idea that we have in terms of implementing the value creation will take place. Again, there is a discussion, there has to be a discussion, there has to be agreement on that. Finally, we go to the regulators. They should feel comfortable. And once the regulator puts his own conditions, we have to see whether it is appealing to our people, whether they can put up with that. So there were many stages through which we have had to pass before a merger could take place.
To your mind, can any of these gaps be bridged? What is the probability of the deal going through? 10%, 20%?
Originally, when people asked me, I said the probability of something happening is 25%. I stick to that estimation, that's all. So I don't feel that anything has happened today to reduce the probability. Because probability means that there is an uncertainty always, you know.
Mr. Thyagarajan, you didn't answer a question I asked earlier. Are you talking to other people for potential deals as well?
No, we are not. Certainly not. Because the exclusivity period is over, it doesn't mean we will start talking to all sorts of people around. No. Prior to this coming into the table, we did not talk to anybody. So we are not going to talk to anyone else. We are not it's not time bound. We are not saying that we should do something in the next 3-6 months. No. There was an opportunity which came along. So we are looking at it seriously. We looked at it seriously. That's about all.
Mr. Thyagarajan, Dr. Rajiv Lal gave an interview to the Economic Times in the morning, and he said that they made an offer, and if you all were not happy with the offer, perhaps there should have been a counter offer, but there was no counter offer. Will you make a counter offer that is acceptable to you?
No, as I said, we don't propose to do it now. We will talk to them. If they are also inclined to talk to us, then we will be talking to them about the other issues involved. And there could be an agreement simultaneously on all the three key issues. The people issue, the valuation expectation, future valuation expectation issue, as well as the current valuation. These three things will have to be taken together. And if there is no agreement on any one of them, even then there is no deal.
Okay, Mr. Thyagarajan, one last question specific to Shriram Transport Finance. I think a lot of people believe that was the issue because of the way Shriram Transport Finance was getting structured and merged into IDFC Limited. Was that the problem specific to Transport Finance?
No, that was an issue which, we said that Shriram Transport Finance, as it was originally proposed by the investment banker and also by IDFC, that it will be completely absorbed by IDFC Limited. There was a change. They wanted a change. We also said that can be considered. It's not a problem. As I said, no decision had been taken. We were exploring what is possible for the other side and what is possible for us. That is an exploration. That's all. In fact, the whole thing is only an exploration to see that we create an enterprise which will create value for shareholders of a very significant kind. And simultaneously will always provide extra value to the community as well. That is what we were trying to work on, and that what is we should be working on into the future also. That is the job of a business organization, to create more and more value to its shareholders and to the community. That process is ongoing. It happens to be with IDFC now. It could be with some other initiatives also here and there, but not in the form of a merger only. It could be, for example, the kind of partnership that we had struck with Sanlam was not a merger. It was a partnership. The partnership with Ajay Brahmal again is a partnership. It wasn't a merger. So business organizations will always be looking at initiatives which will create value for their shareholders. A merger proposition is one such proposal.
All right, Mr. Thyagarajan, thanks so much for joining us and helping us talk through your perspective on this deal. Harsh, I'm not sure I got a clear answer. I don't think I came away with an impression of whether the deal is still on, off, or what.
I think you did a commendable job of backing you off to keep it open. Well, the deal is still on or off, depending on your perspective of whether you're a buyer or a seller. He's still on the table, he says. Well, let's wait and watch how that story unfolds. But the other one, Reliance Communications, that stock is up over 7% in trade today, if I can get that stock up for you. Yeah, nearly 8% after the telecom operator announced a plan that it hopes to reduce its debt pile, as it has been for the past many years. Sajid is here to tell us what the plan is. And what's it called? Asset monetization plan.
It's called the new asset monetization plan. Let me put it this way. So they're planning to sell the assets that's been there for some time, and Ambani has been also talking about it when he came for the first time after 10 years to the media. At that point in time, he said that they've entered into an SDR, but conversion of debt into equity is just an enabling provision and not going to happen because we're going to meet all the targets. What yesterday the JLF has decided and what Reliance Communications has agreed is that as per the new plan, the debt lenders will convert nearly 7,000 crores of debt into equity. That will give the lenders nearly 15% stake in the company. Along with that, what will happen is that they're going to monetize some of their wireless assets. Now this includes spectrum, it includes fiber, it includes tower. Reliance Communication estimates the underlying value for these around 30,000 crores, but they're on a conservative basis, they're expecting around 17,000 crores coming from that. They're also looking at monetizing the land. which is 10,000 crores they expect. It's not going to be entire land parcel. It will be only part of the land parcel in Delhi and Navi Mumbai, and that will be 10,000 crores odd, which will come in. And then when the new resultant company comes up, the new Reliance Communications, which will have the lenders having 51% stake, the promoters around 26%, and rest minority shareholders, that company will have nearly a debt of 6,000
So
crores.
once the entire process goes through, that new entity, lenders will have an equity of 51%.
So the lenders conversions will happen in the first or second week of December this year. Because it's a SDR process, they have a standstill agreement till December 2018. So the lenders by March 2018 is when the first phase of the monetization is expected, which is spectrum, which will happen. 17,000 crores they're expecting to reduce debt by that. Post that, the lenders are also in talks with advisors to start this process. So entire thing is now being monitored by by advisors appointed by the lenders and not by the company. The company will be helping the lenders or in the mandate part of it. We understand very clearly from yesterday's interaction that post March 31st is when the lenders will start looking for a strategic partner for the business, or to sell the entire stake in Reliance Communication, because ultimately as part of SDR the change of control has to happen, and that's when the process will begin. And when that happens, the Reliance ADA group will be a public shareholder in the entire company and not a promoter shareholder. So that's something which is going to happen. The biggest thing here is the real estate monetization part. It's not going to happen in one day, because it takes it's a joint development which is happening. So it will take a couple of years before the money can be realized. So this is something which again the lenders will have to work through and find how feasible it is, because either they hive off the real estate into a separate company and then get the money out, or this is something which I think the JLF will be talking about it. And there are 27 banks and lenders including LIC in that, and I think SBI is the lead lender there. And so this is something which they're going to work on next few months or something, which is going to happen.
All right, Sajid, thanks so much for that. That's the RCom story. The market seems to have liked what it heard, or perhaps there's just a bounce on the stock. Moving on from service providers to tower operators, Bharti Infratel is looking to hike its stake in Indus Towers. The Bharti Enterprise company already holds 42% in the tower firm. Now it plans to make it a subsidiary. Somit Sarkar standing by with details on the shareholding, valuations, etc. Somit, over to you.
So Bharti Infratel is looking to make Indus Towers its subsidiary or a wholly owned subsidiary. Now currently Bharti Infratel owns around 42% stake in Indus Towers, while the remaining 58% is owned by Vodafone, Idea Cellular and Providence. Now Infratel on a standalone basis has more than 39,200 towers with a tenancy ratio of 2.41 times, and on the other hand Indus Towers has more than 123,000 towers and a tenancy ratio of 2.43 times. Now if Infratel fully acquires Indus Towers, the combined entity would own more than 160,000 towers, making it the largest tower company in the world with a tenancy ratio of 2.42 ahead of the industry average of 2 times. Now on the market share, if you see, the combined entity, that is Indus Towers and Infratel, will rule around 39% of the market share, while the remaining 61% will be owned by BSNL, MTNL, ATC, Reliance Infratel and other players. On the synergy sides, there are limited benefits though. The combined entity would have limited operational synergies as they overlap their operations only in 4 circles, that is Haryana, Uttar Pradesh West, Uttar Pradesh East and Rajasthan. However, they would complete their tower footprints across India. Finally, coming to the valuations, the street is valuing Bharti Infratel at 11.97 times its 12-month trailing EBITDA, and applying the same valuation multiple to Indus Towers, the enterprise value comes to around 91,866 crore rupees, which means that to acquire the 58% stake in Indus Towers, Bharti Infratel will have to shell out close to 53,200 crore rupees. Now, this is according to the data compiled by Bloomberg Quint. However, the exact valuations will be known only when either party comes out with the exact valuation multiple.
Soumya, thank you for that. Let's talk about earnings now. Dr. Reddy's posted a steady growth in the second quarter with earnings above the street expectations. Concerns remain in the US business. Darshan Mehta is standing by with a breakdown of those numbers. Darshan, what's worked for Dr. Reddy's?
See, it's a similar story to what you saw with Lupin yesterday, that, the India business is doing okay. They haven't come out with some blockbuster numbers because sales were rather muted. It's basically cost controls that they have done that have led to an EBITDA margin expansion to the tune of almost 18.8%. 16.8%. Our expectation was 16.2%. So operationally, yes, they've done well. The concern for US remains. The US markets have fallen almost 11%, but Europe and the emerging markets have shown good revenue, double-digit growth that has come in. I was not very happy with the India revenue. That grew just 2% on a YOY basis. So that is something that is of a problem. Now the management has also indicated that the R&D costs are now at 11.8%. So what we're seeing is that cost control is coming significantly on account of reduction of R&D costs, as we saw with Lupin. They're saying that now the focus will be on launches, but they do see pricing pressure going ahead. So similar case to Lupin, numbers slightly better than what we were anticipating on the back of cost controls that they've done in the company.
All right, thanks for that, Darshan. Moving back to Bharti, this time to Bharti Airtel. Numbers are expected today. JSW Steel is also likely to report today. Somit is still with us and Nikki is joining us with the sense on JSW. But Somit, to you first. Seasonally weak quarter?
Yeah, it is a seasonally weak quarter, and anyways, Bharti Airtel is not expected to report good numbers. Revenue is expected to marginally be down to 21,754 crore, while EBITDA is expected to be down by 3% to 7,554 crore. Margins would, however, contract by around 60 basis points to 34.7%, while net profit would fall by 4% to 351 crore. Now, average revenue per user, that is a key number for a telecom service provider, would, however, fall for the 5th consecutive quarter by 5% to 146 rupees. Now, the reason behind such a weak quarter, Q2 is generally a seasonally weak quarter. Now, along with this, it was higher tax rate under GST and the continued competitive pricing by Jio, which made it worse for the telecom service provider. However, on the Africa business side, the company is expected to see some recovery because of growth in the top line and margin expansion because of the cost control measures that the company brought in this quarter. Now, the company's EBITDA would be declining for the 5th straight quarter and margins would be at its 8-year low. And if key things to watch out would include management commentary on capital expenditure for the second half of financial year 2018, commentary on bundled phone plans, and impact of the lower interconnect usage charges on the company would be key thing to watch for.
Somit, thank you for that. Last one, JSW will also be reporting the numbers today. Nikki is standing by to tell us what the street is pricing in. Nikki?
Sure. So we're expecting over 20% growth on the top line fund for JSW Steel. On the bottom line, we're expecting a number about 40% growth. Just to quickly run you down through the numbers, for that matter, the numbers are around 15,593 crore as compared to roughly 13,228 crore figure that we're looking at in the base quarter. Also, this is expected to be, it will be marginal to look at the numbers given that Tata Steel reported a disappointing set of numbers. Now, if you look at the net profit figure, we are looking at a growth of 42% there, and we're expecting a number of roughly 1,032 odd crore as compared to a base number of roughly 726 crore. Margins are expected to moderate at around 22% as compared to a number of 20.3%. The factors that we're keeping an eye out, or what do we expect out of this, we are expecting higher domestic prices and average realization. Apart from that, we're expecting lower raw material costs and strong average realization. Besides that, we'll be keeping an eye out on the EBITDA, that's the EBITDA per ton for Indian business, which is expected to grow as much as 10 odd percent. Volumes are seen higher by as much as 2% for that matter. What we need to watch out for will be the coking coal cost for the quarter, if we would like to check if that's moderated a bit for the company, and also the consolidated operational performance and its EBITDA per ton performance in its India business.
All right, Nikki, thanks so much for that. We'll slip into a quick break. On the other side, we'll talk markets and fund flows, and we'll also do a check on the housing finance sector. That's coming up.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive, you will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
You're back with us on Power Lunch. Let's take a look at the headlines at this half hour. Quiet day of trade on Dalal Street after Monday's record closing as investors await big earnings.
Equally quiet start for Mahindra Logistics IPO. The issue receives a subscription of little over 10% as of 1 p.m. on day one.
Online grocery giant Big Basket raises $13 million from existing shareholders ahead of its proposed 20% stake sale to Paytm e-commerce.
All right, let's take a quick deep dive into the markets. Pradeep is with us. Pradeep, what are the markets looking like? Anything that's catching your attention?
So actually, if you look at it, yesterday and today also, while yesterday we did saw index hitting new highs, but there was no follow-up buying interest at higher levels, and story remains the same today. Looks like, in index or say in heavyweights, there is no follow-up buying. There is no selling as such, but there is no buying. So as I have mentioned earlier, that probably for this series, as of now, traders are looking at a range of say 10,450, 500 on the higher side. On the lower side, it could be around 10,100, 150. So as we move closer to 10,400, there is either no buying or there is some selling or squaring of long positions taking place. 100 odd points correction in Nifty cannot really be ruled out in such a scenario, and then probably fresh buying will emerge. If you look at it, PSU banks were moving up, but yesterday and today also there is some correction. SBI, PNB are down, but wherever there is a news, like for Axis Bank, has moved up today with good volume because you have a PE investor maybe putting in $1 billion. Similarly, if you look at the heavyweights, Tata Steel and Vedanta and steel sector after Tata Steel numbers, they are down. But you look at HEG and Graphite. So the mid cap and small cap continues to rise. The momentum is still on the positive side. If there is a good result like Bharat Electronics, it moves up. If a stock like Zentech in small cap, they got a huge order from the government, the stock has moved up quite a bit. Balaji Mines for that matter. So there is a lot of momentum. There is selective buying interest in stocks like Jet Airways, GMR, GVK, or say some media names like in Network 18, we had a block deal, Sun TV also moving up. So if you look at the action is really on the buying side, but it's limited to mid cap and small cap, or it's in select counters because of a news or a result or something like that.
Quite indeed. Pradeep, thank you for that. As markets hover near record highs, brokerage house Edelweiss has been advising clients to exit segments that have turned a bit frothy. In a conversation with Bloomberg Quint earlier today, Nishchal Maheshwari spoke about factors that offer, or rather sectors that offer good opportunities for profit buying. Take a listen in.
This is a good time to take away some profits from the market. Definitely, I think some of the sector where there is a good amount of froth, basically, we are recommending our clients to take away profits there. Having said that, I think what I think at this point of time, basically, to sit on cash, it's a sort of a dangerous thing, given that your performance is continuously monitored. So one should be looking out for investment ideas, and there are quite a few. We have been telling to take away some profit from metals, some profit from the NBFC space. These are some of the sectors basically which we have been asking. Some of the mid caps also basically which have gone ahead much than the valuations and the on a time frame basis.
Okay, that's a view from Edelweiss, but let's also get in a foreign investor view on what's going on in global markets, emerging markets, and India. Ipek Oscar Deskaya, market analyst at London Capital Group, joins us from our studios in Shanghai. Ipek, thank you so much indeed for joining us. Let me begin by this conversation by asking about what you're feeling about risk appetite across the globe. We are awaiting a lot of news from global central banks, from ECB, from Bank of England later this week. What's your assessment of risk?
Well, actually, we can see that the risk sentiment is quite good. It's the risk appetite is quite strong over the past couple of days, and this is basically due to numerous factors. So we can say the U.S. earnings are doing quite strong. So we had very strong third quarter earnings season in the U.S. and the earnings are going to continue kicking in as we go through this week and next. We also have a very good growth number from the U.S. The U.S. third quarter growth has been 3%, which has beaten analyst expectations of 2.6%, so that was very positive. On the other side, in Europe, we had a statement from ECB, a dovish statement saying that the QE is going to continue at half speed, but until September, and that's not going to be the end, so it's quite accommodative. Today we had BOJ, who said that the dovish policy is here to stay, and especially we know that after PM Shinzo Abe's victory, we would expect the Abenomics second version to kick in a couple of months, with not only an accommodative monetary policy but also an extensive fiscal policy. So the risk sentiment is quite okay. We had some problems a couple of weeks ago. That was basically the North Korean worries and the Catalan crisis, but these risks are being priced out of the markets as North Korea. We didn't hear about North Korea since 2 weeks, and also the Catalan crisis seems that it's kind of fading out after the Catalan President Puigdemont had to leave office this week.
Ipek, good afternoon. Ira joining in as well for the conversation. Among the central bank meetings, would the Bank of England one be the most interesting and potentially market moving? I assume the Fed, there aren't very much, in terms of surprises to be expected from the Fed meeting this time around.
So for the Fed meeting, we don't expect any rate action. So the December rate hike is priced in at 85% right now, and with the strong U.S. data, with the strong earnings, we think that that's very much live and very much likely to happen. But at this meeting, there is going to be nothing more than nothing actually. But then the Bank of England meeting is going to be the interesting one. So the inflation in the UK hit 3% level, and that was the threshold. And the Bank of England is left with not in a palette of choices, but it has to hike rates, because if it doesn't do so, there might be some further problems. So the Bank of England will likely raise the rates by 25 basis points, and that's mostly priced in the market prices. So that's not going to be a motivation for the GBP bulls to jump in the market. What investors want to hear is more than a simple rate hike. We want to hear the BOE's commitment to more action if the inflation pressures are not coming down after the first rate hike. Investors want to see that the BOE is ready to take further measures in order to cool down the inflation in the UK, and that despite the Brexit situation. So that's exactly what the pound traders are looking at. A 25 basis points hike per se will not be enough to keep the GBP US dollar above the 130 level or the Euro GBP below the 0.90 level.
Ipek, I want to shift the focus of this conversation to fund flows. What does this mean for fund flows into emerging markets? I was looking at the MSCI Asia Pac Index on the Bloomberg, and that reveals that for 10 weeks in a row, the MSCI Index has actually gained. Are emerging markets, will they continue to be recipient of global liquidity flows, you would think? In India, there's been a slightly separate story. The last few months, we're actually seeing fund outflows, particularly from foreign investors. Do you see that turning around? Would India start receiving the quantum of money, let's say, Korea or Indonesia has been receiving?
Well, actually, there are two dimensions in this. The first dimension is the Fed and the US dollar. So if the US dollar starts strengthening further, that's going to be a knee-jerk negative impact on the emerging market businesses due to the fact that the commodity prices are going to be more expensive in local currencies. The energy prices are going to be expensive, and that's going to be a little bit more costly for the businesses. But in term, it's positive. I think that the fact that we have good news from the US, from the Eurozone countries is good news for the emerging markets. Also due to the fact that the weakness that we have been seeing for years was mostly due to demand, a lack of demand, and now it's going to be an increasing demand from the developed world is going to kick in the emerging markets, and that's going to be a positive effect on the supply side also. And if you just can get the supply side going, that means that the economy is going to go for a further recovery, and that's going to boost the stock prices higher.
Okay, very quickly, just a point about the dollar that you mentioned. You know, we're seeing the dollar weaken against most currencies, against the euro, against the yen, or most Asian currencies. What's driving the direction of the dollar at this point in time?
Well, actually, right now we can say that the US dollar has, we saw the US dollar went to 3-month highs, and right now it's coming a bit lower. That was due to the political risks because of the investigations with Trump and the Russia ties. But in turn, we are looking at the US dollar as a strong currency due to the fact that the Fed is tightening already its policy. So the European Central Bank is still on hold. The Bank of England is going to tighten, but we don't know it's going to be a dovish hike. We know that the BOJ is staying pat, but the Fed has already raising rates a couple of times, and it is expected to continue tightening its rate policy, and that's basically a strong basis for the US dollar to at least keep ground and continue going higher. So when we see the temporary impact, the temporary sell-offs in the US dollar is basically due to the fact that a part of the rate hikes, a part of the Fed's tightening policy is already priced in, but then you have the fiscal side of the game, and it comes on and off due to the fact that due to the uncertainties on Trump's ability to push his fiscal reforms. But if we have more clarity on the fiscal reforms, then that will push the Fed's hand to tighten maybe a bit more quicker, even though we have a dovish Fed chair. A new Fed chair is Powell, for example. He is in for low interest rates, but even he will be constrained to raise rates if we have some more clarity on the fiscal reforms, and that's going to be a positive risk on the US dollar.
All right, we'll leave it there. Thank you so much, Ipek, for joining us. Ipek joining us from London Capital Group in our studios in Shanghai. China's official factory gauge fell this month, with new orders and prices leading the decline. The manufacturing PMI fell to 51.6 in October from a 5-year high of 52.4 in September. This as officials increasingly prioritize a campaign to clamp down on polluting industries and rein in debt. The non-manufacturing PMI stood at 54.3 in the previous month. Remember, numbers higher than 50 indicate improving conditions, while readings below 50 signal a contraction.
All right, that's the global picture, global markets and global economic data. Let's bring the conversation back home. Housing finance companies have been the darlings of investors, at least in the early part of the year, with many arguing that this is a low-risk, high-growth business, and it is. But it's not possible to ignore some of the risks that have been emerging in this business. In a note issued on Wednesday, rating agency ICRA pointed out that the share of housing loans in the overall portfolio of housing finance companies has been declining. Instead, the pace at which non-housing loans are growing is picking up. The rating agency also pointed out that increased competition in the housing finance segment has led to some dilution of lending norms. Another important point highlighted in the report is that the geographical spread of loans has not widened as much as you would like it to. Karthik Srinivasan is head of the financial services business at ICRA. He's joining us for a sense of what's happening. Karthik, good afternoon. Thanks so much for taking the time to speak to us. Interesting report, because I think throughout the assumption has been that housing finance is the best business to be out there right now, and it perhaps is if you compare it to other segments. But I think you're highlighting one important point, that the proportion of housing loans in the overall portfolio of HFCs is coming down, particularly in some segments like smaller HFCs.
Yeah, what we've said in this report is we've done some portfolio cut analysis for about 24 companies from whom we have more granular data. The analysis reveals that the proportion of non-housing loans has been steadily but slowly increasing. One of the reasons for that would obviously be the competitive intensity in this segment is quite large with all players, whether it is banks, the larger HFCs, the smaller ones, the new ones, everyone trying to expand their business. And in order to sort of shore up their profitability, we are seeing entities across the spectrum try and build up their non-housing portfolio as it gives them a better risk-adjusted return. The affordable housing or the smaller HFCs obviously look at the loan against property segment, whereas the larger HFCs, given their stronger balance sheet and their larger net worth, are able to cater to builder financing to provide an overall yield pickup and slightly improve their operating metrics by using this strategy.
Okay, Karthik, just hold the thought for a moment. We're just getting in the middle of some earnings. Dabur's numbers have come in at about 362 crores on the net. That's against an estimate of 365 crore. News flashing across the terminal right now is the number on the second quarter revenues are about 19.6 billion rupees. Total cost of 15.9. We'll wait for some more details on how what are the numbers that we have. Net profit has come in at about 362 crore versus an estimate of 365 or 370. That stock is not moving marginally. It's marginally up about 1% in trade today. That's Dabur for you. We'll try and get you more details as when we get them. Dabur's second quarter numbers. Karthik, let me just come back to the point that you were making about the housing finance companies. My question to you is, what is the underlying risk that you're trying to sort of detail? Are you suggesting that this will lead to higher recognition of NPAs? Is that what you're alluding to?
Now, what we're seeing is from historical studies, the conventional home loan, the losses have been very, very low. But compared to the non-housing portfolio, whether it is builder financing or loan against properties, the risk is definitely higher as compared to the conventional housing loans. So over the last couple of years, with the mix of non-housing loans are increasing, we are just saying that there's something to be watched out for. At this point in time, the risks are still manageable. One is not really losing sleep over this. But we're just trying to reiterate the fact that in quest of shoring up profitability, there is a small bias towards realigning the portfolio mix. So that's something which one has to be cognizant of, and one needs to watch out for how this pans out over the next couple of years.
Karthik, so these loan against property segments, and I know you said that they make up about 25% of the non-housing loan books of smaller HFCs, if I have that number correct. Can you give us any sense of what the asset quality experience in this LAP product has been? Nobody really has a clear sense.
No, LAP product, the nomenclature is quite varied across various players. You have some entities calling it as an SME loan, some entities call it LAP. But if I was to sort of just look at it on a combined basis, NBFCs are also quite active on the SME stroke LAP kind of a financing, so are HFCs. The primary customer profile for all these are the self-employed kind of a segment. So if we were to broadly look at this particular segment, the 90-day delinquencies, which let's say a couple of years back was about 1.5% or thereabouts, has definitely increased close to 2.5 or 3%. For some places, even exceeded 3%. Whereas on the home loan portfolio, at a system level, the 90 DPD or the gross NPAs at an average are still at about 80 basis points. Our own assessment over the near to medium term, it should still remain within 1.3%. So to that extent, there is definitely a divergence in the credit profile or the risk appetite of these two product segments. And as the proportion of non-housing increases, one has to basically look out for for risk in case it emerges as far as select players are concerned. At an overall industry level, what we've been seeing is while delinquency numbers have been increasing, the property values have not really fallen. We've not had too much instances where one has had to repossess, sell, and maybe at an overall loss levels, the numbers are still under control.
Okay. Karthik, just
should this trend increase and
No, sorry, I didn't mean to interrupt you. I was just going to put in one last question before we run out of time on the conversation. You pointed out the geographical spread. I'm wondering what point you were making in that. Are you saying that some of these markets are getting more concentrated and hence lending standards in HFCs which are concentrated here may be under pressure? Why did you make the point that this lending is very concentrated?
No, what we've just said is this is the fact. I mean, from the various portfolio cuts that we've got, we've seen that almost 60% of the loan book for the 24 odd players that we've analyzed, a large part of the business comes from the 4 states: Maharashtra, Delhi NCR, TN, and Karnataka. Similarly, if we were to look at it for the smaller players, a similar amount of 60% comes from the west of India. So it's just a point that we're just trying to highlight, that across players, a large part of the business seems to be, relatively speaking, in these 4-5 kind of states. While the government thrust on housing for all by 2022 and the recent pace of new buildings, new homes to be constructed pan-India, especially on the affordable segment, one could see this trend change over the next couple of years. But as we speak, this is what the data point suggests.
Thank you. We'll leave it there. Many thanks indeed for joining us. That's Karthik joining us from ICRA, talking about the housing finance report. We'll get back to earnings and talk about Dabur. The net number on Dabur was about 362 crore. Bring up the stock. You don't see too much of a reaction. It is reacting at this point in time, about 1.5% up on Dabur India. Agam is standing by to give us a sense of what these numbers look like, whether part of did they meet the street or not. Agam.
Oh yes, so we have seen Dabur miss expectations both on the top line as well as the bottom line. I'll start off with the revenues. We're looking at a decline of as much as 1.2% at around 1959 crores. And when it comes to the bottom line, we're looking at a 1.4% growth. It's a miss considering the fact that we were expecting the profits to come at around 370 crores. It's come at around 363 crores. The surprise perhaps here is, and one might ask as to why we're looking at profits which are largely in line, considering we are looking at a decline in the revenues, is because of margins where we've seen Dabur maintain the margins around 21.5%, slightly ahead of what we were working with. If I'm not mistaken, we're looking at volumes of around 7.2%. So that again is something which was largely in line with street expectations. We'll have to wait and watch as to why we're looking at that decline in net sales and how pricing has affected Dabur's top line, considering the extreme competition that it has seen over the past few quarters.
All right, thanks so much for that. That's Dabur numbers. Just staying with news on the corporate side, we've got the Mahindra Logistics IPO in the market. Subscription numbers, first day not that great. 10% has been subscribed as of 1 p.m. The third-party logistics provider is looking to raise more than 800 crores from the primary markets, a chunk of which will be invested in ramping up its e-commerce service vertical. That's what the company said earlier today. Let's listen into the management.
E-commerce has been one of our growth areas in the last 2-3 years. We forayed into the e-commerce industry in 2014, and between 15 and 17 we grew that business at 110% CAGR to more than 200 crores. And we play in the e-commerce supply chain right from transportation to warehousing to sort centers to distribution. We are also taking a look at a couple of other services. One of them definitely being cold chain for the pharmaceutical sector. We have identified that moving ahead, pharma companies will require cold chain in a big way, and we are evaluating that as one of the sectors.
Okay, that's the management of Mahindra Logistics. Meanwhile, Big Basket has raised about $13 million from its existing investors, even at a time when the online grocer is nearly closing a deal with Paytm. Nishant Sharma filed this report from Bangalore.
India's leading online grocery firm Big Basket has raised $13 million in its fresh round of funding from existing investors, including International Finance Corporation, Sans Capital, Helion Venture Partners and Abraj Group. Documents filed with the resort of companies showed. Now, this fresh investment comes close to the heels of $200 million. Big Basket is already in talks to raise from Paytm E-commerce Private Limited, the company behind Paytm Mall, which is also backed by Alibaba Group. Bloomberg had reported in July. Now, according to one person privy to the development, the deal between Paytm and Big Basket is a done deal. An announcement could also be made in the coming 2 weeks. Big Basket, which is present in about 225 cities in the country and allows customers to buy everything from staple to soap, is further looking to reinforce its position in the Indian market and expand its operation amidst growing competition from Seattle-based e-commerce giant Amazon, homegrown e-commerce players Flipkart, and also from India's most valuable supermarket giant DMart.
Nishant reporting from Bangalore. Out of time on the show. Thank you so much for joining us on lunch today.
Have a good afternoon.